Well, I'm joined again by Peter O'Connor, Shaw and Partners, very well regarded, I say that all the time, Peter, but very well regarded resource analyst here at Shaw and Partners. I'm framing this resources with Rocky. It's a little bit different. Rocky's your nickname, of course. And I want to sit back here and focus on the backdrop of what's happening in the resources space at the moment. We've had some parts of the resources sector that's been going gangbusters and some have been struggling. I want to get your take on those areas that are doing well and can continue to do well. Some of the value areas, I think there's some parts of the resources space where values are emerging, and then we'll finish up by getting your quick take on some the names in the sector, whether you like them or you don't. So we'll start here. What things have been going well and still look good at this point in time?
It's been interesting, Jason. We'll talk about this. There's demand drives resource stocks, so does supply. What's been driving a lot of the names I'll talk about is supply. It's very different to demand cycles that we normally have, and we're about to embrace a demand cycle, which is positive. But supply's been driving a couple of commodities. Iron ore early this year with the Vale incident in Brazil back in January. So that was a 6-month backdrop and potentially longer of higher iron ore prices, higher earnings, higher cash flows. That's been very good for Fortescue, BHP Peter O'Connor and the smaller iron ore names.
Fortescue is still trading up around all-time highs today, up 3%. They're all having a good day today.
They are. And that backdrop, given that demand story we can talk about, that's favourable from here as well. So the iron ore price should stay higher for longer. Not spike again, but just stay higher for longer, which means they generate cash, pay down debt. Dividends come on the back of that as well. But the other is nickel. Nickel's been a fascinating place to be, and it would have been one of my top picks, and it has been for quite some time, but since September this year it's had an extraordinary rally because of events on the supply side in Indonesia, which look like they'll continue. It's tightened the market a bit quicker than we would have thought, and equities have responded.
What's Indonesia doing in that regard? Are they making a play on the longer term demand for nickel? The play on batteries, etc.?
It's more about resource rent. It's about keeping the value in the country, not allowing it to escape. So think of Australia. Unfortunately, we're a bit of a quarry. We dig and we deliver. Indonesia's saying we dig and we deliver, but what if we try and value add?
Isn't that sensible?
It is, but we sit here and get, but they're disturbing the industry, but really they're actually been sensible. They've been doing this since 2014. They first put in place a ban of low-grade export material and said we want to process further. They turned that around in 2016, changed again in 2017, and most recently they've brought forward what was going to be a 2022 final cut-off date, no more export of low-grade material. They brought it forward to January 1, 2020. So that came out in September, scared the people in the nickel market, saying how will we get this supply? Indonesia is one of the major suppliers globally, and they supply China in particular. So there's been a bit of a scramble for material, and stockpile levels have declined to show that, and nickel equities responded following nickel price. It feels a bit today like that has now priced in that short-term event. So all things being equal, I would have thought nickel equities looked fantastic 3 months ago. They're now looking pretty richly valued. So to go higher, like iron ore, they need to have that tailwind continue. And with Indonesia doing some inspections and further bans just recently, it looks like that may continue, but that big one-off uplift, it's probably done. And from here, it's more a grind higher.
But it's the concept you've talked about in iron ore, it's about that sustainable higher price point.
Correct.
That underpins strong cash flow going forward.
There's a whole separate story in nickel which we could talk to for hours, which is about where it goes in the 3-year, 5-year view, and that's what looks exciting anyway. This has just brought it forward. So nickel price will be higher. It's just a function of maybe not any higher for the next year or so. So it's going to grind higher. Cash flow they'll generate will be substantial, and the earnings leverage is extraordinary. One of the local minnows, western areas, its earnings have gone up tenfold on forecasts this year compared to last year. That's the type of leverage you buy when you buy.
And you're starting to see momentum funds go into the nickel space. I think the downtrend seems to be broken in terms of nickel equities as well as the nickel price. Now, things that aren't looking as good at this point in time, I think about the other commodities that are on the nose, coal. Aluminium's been on the nose for a little while, and the miners that are exposed to those areas. What about that area of the market? Is it too early now, or you've been quite negative in that area, and rightly so? Yeah. What about now?
So we've talked for about a year and a half about this, and I've been negative all the way through, and I'm now coining the phrase that those areas look interesting. And why? Because the valuations have come back. The commodities have come back and retraced a substantial amount of their gain, and they're actually starting to look from a supply and demand perspective interesting. And
so you're sitting on the fence for now, but ready to hop the other side.
I've gone from a negative call to an interesting neutral call, and my next move is higher. And all I'm waiting for is the demand trigger, which we can talk to. that will see these things go higher. So coal feels like it's at a low. 50% retracement from its high, manganese is another commodity 50% down, alumina likewise. They're all looking like they're about there. So if you've got the slightest uptick in global demand, be it a China trade deal with the US, that should see those things bottom, and the equities therefore see their low. And I think we're at that range. They're in value territory for the first time in a very, very long time. They're not deep value, but they're, again, interesting, and my next move is higher, not lower. So the risk-reward trade is higher.
It's interesting where you see momentum funds going into Western areas. You are seeing value-orientated funds, target those parts of the market. Of those three, of Whitehaven that you cover, South 32 you also cover, and alumina, is there one of those that looks more appealing? I've been looking at South 32 on the radar. We don't own it, but I've been looking at it.
I'm going to say South 32 because why I like that, it's capitulation of the longs has occurred. Alumina, it hasn't occurred yet, so I think that's still some part of the process. Whitehaven would be my second pick, but South 32 gives me a suite of commodities which will give me more leverage and an uptick. So it's got the industrial metals, which I like. It's got coal as well, so it gives me that. It gives me diversity, net cash in the balance sheet, and it's probably cheaper on a lot of measures compared to Whitehaven. So I'd say South 32, and it mainly because that shareholder capitulation. There's a lot of stubborn funds that were saying, no, it's cheap at $4. At $2.65, they're going, you know what, I've been wrong. So I'm more inclined to buy that one for that reason.
What's your take on, just circling back to the big guys? So I made mention of Fortescue trading up near all-time highs today. BHP and Rio have come back probably more sharply than the market was anticipating. It had that assault on, in terms of BHP, the assault on 40. It's come back to 34, 35. It's now 36.50 thereabouts today. What's your outlook on BHP from a shorter-term tactical standpoint?
Given the more constructive macro environment playing out and the likelihood of a trade agreement of some form being signed soon, that will be probably the key catalyst to see those stocks move higher. So, and BHP gives you the greatest suite of diversity to that. So oil will move as a growth proxy, copper will move as a growth proxy, and it's got iron ore, it's got coke and coal. It's just got a little bit more upside potential than Rio in the short term. But if I gave you a view out to the end of the year, which is only 2 months away, BHP should start to nudge back towards those highs. Rio will probably do the same as well. And the iron ore story, which has been holding Rio back more, will start to undo a little bit and see it punch higher.
Is it all predicated on a trade deal happening? So, if this backdrop of global growth and whether or not we're going to see global growth pick up, it seems to be linked pretty heavily to what's happening between
absolutely
an uncertain situation, if you like.
The key word to take beyond trade war is confidence. Now, whether a trade war actually affects demand, but it affects decisions to buy things. So think of a procurement manager or a chief financial officer thinking, what do I do now? Do I buy more iron ore to make steel, or do I sit and wait? They've been waiting. So if there's some form of trade deal, which Trump will no doubt talk it up, no matter what it is, as a purchasing manager anywhere in the world, I go, you know what, the world's looking a little bit better. Maybe I'll go out and buy that extra ton of coal or iron ore. So the pipelines will be restocked. There's been a lot of destocking over the last year. So again, it's more a perception thing, a subjective issue than a quantifiable number, but the trade war issue has been affecting confidence, and confidence typically can take people into areas where they hold back, become more reluctant to do things. Unblocking that could help a lot. So that's why I see a trade deal will probably be the single biggest catalyst we see coming to the latter part of this year and next year.
So then that speaks to me, you want to be exposed to the growth orientated base metals. Brings in the copper in the play. Yeah. Oz Minerals, which we've got in the portfolio, has just had a really good spurt up above $10. Anything else in that sector that's coming to mind?
If I had to say what is cheap, it's the industrial metals, which includes aluminium, copper, nickel, lead, zinc. But it's also the energy side, so coal, oil and gas, they're in that cheaper category as well, which they've all growth proxies. So if growth starts to be freed up by this confidence change, they'll all do well. But copper stands out because it hasn't moved. And they talk about this cliche Dr. Copper. It's probably been the most laggard of all the industrial metals. Nickel we've talked about, that had a specific supply response. Aluminium is getting close, but there are some impediments. That capitulation hasn't occurred yet in either the aluminium market or the equity market for aluminium. But copper looks really interesting. It's trading on a 10-year chart on an uptrend line. It's either going to break it or not. But given that more constructive trade backdrop, it looks like it will hold that trend. Copper price may have seen its low for the year, and we should move higher. So I see copper as one of the better performing commodities as well as equities going into the new year.
you see that. To me, it seems like you need that circuit breaker, that catalyst, that external catalyst to change people's opinion from being, things being soggy in a downtrend to be, to change it. You saw it with iron ore.
Yep.
We've seen it with nickel.
Nickel, absolutely. When they change very,
They
very
do.
quickly.
They absolutely rip higher, and that's, I guess, from an equity investor standpoint, that's the moves we're looking for. So those things look good. What about the things that look a little bit overstretched here at this point in the cycle? I know you're still positive on iron ore. You're positive on copper. Things that you're not positive on.
Just by extension, if you're positive on growth, you have to be negative on
defence.
The defence. And in the mining space, the hedges that you use are gold. We use it in our portfolio here. A lot of people buy gold as a hedge. Gold looked a great place to be when it was at an all-time high just 3 months ago. Gold will have a headwind for the foreseeable future if growth is back on. So whilst gold equities, I couldn't articulate a case why they're not doing well, but I just say they've got a headwind in US dollar terms and Aussie dollar terms, gold price, and they'll struggle given that backdrop.
Do you think that's to a degree priced into gold equities? I mean, we've seen the gold price drop, but not to the magnitude that gold equities have dropped, particularly in Aussie dollar terms.
The multiplier effect will mean they'll trade on a ratio on the upside, 1 to 2 times more than the gold price, and on the downside they'll do the same. And they've certainly accelerated more than the gold price, but that's partly reflecting that they were stretched on value, and as soon as you get a negative headwind and you're stretched on value, it's going to be a challenge to hold that up. So,
yeah. It seems to me that the gold, what's happening in the gold equities is a sign that the market's becoming a little bit more pro-growth.
In fact, look, it's interesting if you were to look back, it doesn't feel it now, but on 28 August, I'm prepared to go out there with the date, 28 August was the bottom.
Yep.
And that was the day when US 10-year bonds bottomed. And as a proxy for global growth and global risk, that was the day. And if you look at how gold's traded since then, it's traded lower or sideways to lower. And a lot of asset classes have had their peak or their trough back at that point. So gold has had its run, I think, for this economic cycle. So we saw the prior high 2011, this high 2019 in Aussie dollar terms. Again, gold equities are doing nothing wrong. Net cash in the balance sheet, smart acquisitions, smart exploration, well run. You couldn't floor them for what they're doing, other than their revenue is going to be lower than what we thought. So,
And they've had, you talk about...
and they're not cheap. They weren't cheap. They were stretched for a reason, and now they're starting to retrace. They'll become attractive again, perhaps in the next couple of months. But right now, I wouldn't be long a gold stock unless I just needed a hedge in my portfolio.
To give you a backdrop in 10-year bond yields, they based out around 1.4. They're now above 1.8. So that's a big, these are a big move. And we've been in this scenario of, decades of bear market in terms of bond yields, and that, it seems to us at least that the low or the bottom in bonds have been bond yields, I should say. And whether or not they trade sideways from here, that's another story. I don't think they'll rip higher in terms of yields, but it does imply, it speaks to the growth theme starting to gain some traction. I'm going to run you through some quick stock codes. I want some quick answers on bullish, bearish, otherwise. BHP in the large caps.
Bullish buy on that near-term 1-3 month view. Trade resolution, leverage to copper, oil, iron ore, coal, great place to be, and balance sheet management, tick, tick, tick.
Rio.
Same, it'll get dragged along. You could have either or, so bullish on that one.
Are you more? I mean, Fortescue and Rio, it comes down to risk profiles, I presume. But the Fortescue in the last couple of years, the deleveraging that they've got, the risk profile is significantly less than it was in years gone by.
$12.5 billion of debt 5 years ago, which is now will be net cash at the end of this fiscal year. That's extraordinary. So they've just basically grown their value by $2 billion or 70 cents US per share, or $1 Aussie a share, just in the last 6 months. So, and that can continue as they generate cash. So forget about thinking about it as a dividend pay, but just that cash generation will grow the value embedded in that company. In
the copper space, Oz Minerals, Sandfire's been the lagger. They've had some operational issues, but they're obviously exposed to copper. They need a copper price tailwind. Would you stay in quality, or would you go down and look from a relative valuation standpoint?
Huge fan of Oz Minerals, but I'd be buying Sandfire. Why? It's cheaper. The operational issues that it's had, I think will be addressed over the next few months. They weren't really a big deal, but the market took it on board because copper price was low, the outlook looked poor, was easy to be critical. And they've mapped in place or put in place a very good, well programmed growth strategy. So I like Sandfire, and with the the slightest uptick in copper price, what do you buy? You buy the levered one, and that's the one I'd buy. You look for the laggards in each sector, and if they've got a balance sheet which is suitable, they've got good management, good assets, I'm happy to buy Samphire.
Are you on Western areas over Independence Group because of, IGA's got more gold exposure?
Look, if I want to buy nickel, I want to buy nickel. I don't want to buy gold. So I want to buy Western areas because I want to buy pure, 100% unadulterated nickel price, and I want to get that leverage that goes with it. So Independence has nothing wrong. The acquisition they announced today is an excellent acquisition, but I want to buy 100% nickel. If I wanted to buy gold, I'd buy gold stock. So that's a hybrid which some people like, but I'm a fan of pure plays. So
then recapping the three dogs that we spoke on earlier, South 32, Alumina, Whitehaven Coal.
Yeah.
What would you go out of those three?
South 32 Whitehaven, very happy to, as I said, I'm in an interesting category now, but I'm on the buy side of both, so my next move higher, and that risk reward is definitely higher. Alumina I'm avoiding. It just hasn't yet gone through the capitulation as a commodity or an equity it needs to, and I think when it does occur, we're going to sit back and go, wow, I didn't see that one coming, but it's going to happen. So that stock should be trading with a 1, not a 2 in front of it. It's still 30 cents away. So
Nearly got there, didn't it?
It got nearly 6 cents, and maybe I'm being a little bit too cute, but the market is still overpricing that on every correlation I could possibly put to you. So I don't see that the market being properly informed yet. So avoid that one. South 32 Whitehaven, definitely happy to look at the long side of both of those for the first time in a long time. And I know it's been picked up by a lot of people in the market. That's quite a change in view for us here at Shaw. So happy to be there.
All right, Peter, thank you very much for joining us as always, and we'll talk again soon.
Thanks, James. Thank you for the time.